Hello everybody, welcome to PA Online 2020 Shape the Debate. My name is Dean Shepherd, I'm from Wolters Kluwer and I'm your host for today. And in this live session you can put your questions to Tony Austin and David Potts and interact with them as the information is being delivered. Today's live Q&A is due to last 1 hour. And we'll cover your pre-submitted and live questions. To the right-hand side, there's a chat function. All questions are submitted in private, so please do ask away. If you're watching a replay of the live chat function, the live chat function is obviously disabled, but you can contact professional accountancy for any further information. So let me introduce my esteemed panelists for today. We've got David Potts. He's a chartered accountant with considerable experience in financial training. He provides training on all aspects of financial reporting, ranging from the smallest owner-managed businesses right through to issues affecting the major international PLCs. I think you'll all agree that David is able to appreciate the practical implementation of developments for users and preparers of accounts. Hi, David.
Good afternoon. Thank you very much, Dean.
Great. David did some excellent sessions on key financial reporting issues for SMEs and key developments under IFRS. So I hope everybody's had an opportunity to watch those. And next we have Tony Austin. Now, Tony's been a chartered accountant and tax specialist for over 30 years, 20 of which were as tax partner with BDO and Mazars. And he advises on all aspects of direct taxation and tax planning for owner-managed businesses and the people that run them. Hi, Tony.
Hi.
As part of PA Online 2020, Tony did sessions on General Tax Update and Finance Act 2020, Business Asset Disposal Relief, formerly known as Retirement Relief. Sorry, formerly known as Entrepreneurs Relief. I skipped a generation there.
Yes.
And CGT changes regarding residential property. Finally, myself, I'm Dean Shepherd. I'm an accountant, tax advisor and technologist. I spent 20 years in practice, the last 10 of which was building up and eventually selling my own practice. And I now work for Wolters Kluwer on their CCH brand of compliance solutions. One of my primary responsibilities is making tax digital for income tax. So if you have any MTD related questions, then I shall do my very best to answer those for you. So let's kick off. We'll address some of the pre-submitted questions first, and I'll be keeping an eye on the Q&A panel to the side there. So if you do have questions as we go through it, please do just enter those into the panel and we'll put those to Tony and David. So the first question we have, I received a COVID-related support grant from the local authority in May. But I'd originally applied for it in March. When should I recognise the income in my accounts, March or May? And that's probably one for David.
Yeah, no, I think it probably is, Dean. I've been asked this or similar to this a number of times, and obviously a lot of things like this, it's new to all of us for 2020 because, you know, in my business life, I don't think I've ever claimed or been entitled to any kind of grant or allowance, and then suddenly there's these whole lists, whether it's local authority, central government grants and allowances, which takes you in, if you're using FRS 102, which obviously I'm guessing many people will, it takes you into the section dealing with government grants that you might not have looked at before. And what it says there, and there is specific guidance on the timing of recognition. What it says is you need to demonstrate that you're entitled. So first, that there is an entitlement to claim, so whether it's rates relief or whatever, and the grant has been approved. But I've had this question from other people as well, say, well, there was a delay. You know, we were entitled in March, but by the time we'd gone through the application, it was thrown back at us because, you know, we're working from home. We hadn't seen the forms before, and it came through in May. And the complication, you know, is often that if your tax year end is March, you know, does it go into that year as taxable income, or can it be pushed down into May and at least be offset by some of the other losses? There's been extra guidance issued recently, I gather, and this has come out from the Scottish Institute, so ICAS, who've again gone through, said, if you are entitled, but also are you going to apply? So are you going to the applying process? So are you going to claim it? And has it been approved? So you would be going through to tick all three boxes. So I would take the view that as there is an element of contingency about this, there's an element of, are we really going to get the money? That there is always that sense of, if in any doubt, to delay it. So yes, if you're still waiting for the final say-so for approval, I would say you wait with the recognition until you get that final say-so. Yes, you're on the list. So that would lead me to take the later period. Great.
Thanks, David. That's very clear. Revenue recognition, always a very tricky one, and getting that cut off right.
Yeah.
So another question we've got here, a bit of a change of topic here. I've heard people talk about corporate interest restriction. Should I be concerned? What companies would corporate interest restriction apply to, Tony?
Well, that applies to, I suppose, really very large companies, because in order for it to hit your bite, you look at it group wide, the total group deductible interest before any cap has to exceed the group's interest income by at least £2 million. So unless you've got £2 million of UK interest deductions, you don't even need to have to think about it. But if you are in that situation where your group interest payments are exceeding your group interest income by UK income by that £2 million, then your interest deduction, the amount of interest that can be claimed for tax purposes, is restricted. The basic restriction is actually 30% of the EBITDA. But of course, being taxed is not the EBITDA that your financial accountant would have come up with. This EBITDA based on tax principles, using tax-adjusted figures for earnings. Probably in many cases much the same, but it can make a difference. So that's the limit, the £2 million of interest.
Okay, that's pretty clear, Tony. I think I can safely say that wouldn't have been an issue for any of the clients in my previous practice.
Nor mine.
Okay, another accounts related one has come in. I prepare accounts using FRS 102 and received a bounce back loan in July. The government will pay the interest for the first year and will cover the arrangement fee. Do I have to report anything in my accounts to reflect this?
Again, it's a kind of similar topic as most I've been talking about this year, which is kind of COVID related, because even though we've had a kind of lucky year insofar that the FRS 102 changes have all been quite well established and been thought through, suddenly there's all of these issues being raised, and a bit like with claiming a grant. Suddenly you claim these new loan arrangements and fees are being picked up by the government. The first year's interest is being covered by the government. And it just kind of is trying then to apply the existing guidance to this new unusual arrangement. There's two sides to it. The first one is, who is actually responsible for the arrangement fee and the interest? Is it that your lender, because these loans you apply to your individual lender, so that could be HSBC, it could be Santander, it could be Lloyds. I know a lot of them have now stopped issuing them since the kind of huge volume of demand, but you apply to your commercial lender, but they then will have the arrangements with the first year's charges as suit them best. And as far as I can tell, different lenders have taken different views. Some are actually looking to charge the commercial borrower, so with the company, but then looking to recover that from the government. So they'll recover it from the government if they can, but there is this legal position that they could charge the commercial borrower. Other banks have taken the view that this is just an arrangement between them and the government. It's nothing to do with you. So again, you've mentioned revenue recognition. This is another kind of perennial topic. As regards the arrangement fees and the interest, are they being charged to you in principle by your bank, or is there an agency arrangement where effectively you're not directly involved? Unfortunately, I can't give a conclusion for every single bank and lender. Some have gone one way, in which case you would record it as an expense, and then you would show the government's covering it as income, as grant income. Others have just decided that they're just going to charge it direct to the government, in which case it wouldn't touch your accounts at all. Obviously, the net impact would cancel out, but it's just whether you recognise it. There is a slightly more complicated issue on this as well, which is obviously whichever way, it's going to be interest-free and arrangement fee for a year. But then for the next 5 years, there is going to be a rate of interest, which is potentially about 2.5%. So it does average around a rate of interest of 2%. And what you're required to do, even if you're a small company using FRS 102 1A, if a loan isn't charging a commercial rate of interest, then what you should do is you should impute, you should work out the internal rate of return, and from that you should impute what is a real commercial rate. So there is this argument that if on average you're paying at 2%, but a commercial rate would be more like 10%, then rather than showing a loan £50,000 maximum bounce back, say, and 2% charges a year, you would discount the payments using discounted cash flows at 10%. And this is the kind of topic we've had before with things like directors' loans, intercompany loans, and I feel so many people feel, and their truth and fairness disappears over the horizon as we have these kind of discounted cash flows. There's no clear position on this. My view would be, as those loans were available to everybody, and the only criteria was the pandemic has affected you, in these unusual circumstances, that's the commercial rate. So that would say just keep it simple, record the fees as they're applied, and just disclose the arrangement. But yeah, it's not easy, but that would be my view on it.
Great, thanks, David. Yeah, it is very tricky, isn't it? There's obviously a lot of pressure on accountants when all these different range of measures were quickly enacted, and advisors having to give their clients accurate advice and go through all the application process in many cases, but it doesn't end there, obviously. We're at the other end and reporting.
Yeah, and it's being isolated as well. If you're working from home, the kind of thing, if you're in an office, you could share and discuss. And also, between now and March, there's probably going to be more, I'm guessing. So, we're not over it yet.
Right. So I switch back to tax now. We've got a question here. We've heard there's a rumour going that there's a new CT 600 supplementary page for R&D. Tony, have you heard that rumour? Do you know when that will come into effect?
To be honest, no, I haven't heard that rumour. I mean, I'm not surprised, because claiming R&D does seem to be a bit hit and miss depending on what software you use and how much information you decide you're going to disclose. And I know a lot of specialist R&D help providers, companies that specialise in this, who I believe submit claims separately to the main tax return. But I've not heard about a new page. I don't know if your company, Wolters Kluwer, have got any pages being lined up for their software. As for when it comes in to take effect, it'll be whenever HMRC decide they're going to issue a new CT 600.
Yeah, we have heard whispers for some time that a new CT 600 is coming, and of course, so that we can get it into our software, we usually get early sight of these new forms to give us time to prepare for those. So I think there may be something coming. It certainly makes sense. We certainly get lots of questions about R&D from our users, and we've got a myriad of different guides for how you might get that information in, but it's certainly not a straightforward area.
I mean, the CT600 actually doesn't carry, does it, a great deal of information anyway. I've always found it a bit puzzling as to what it does show and doesn't show, because I'm sure HMRC software works fine with it, but if I'm reviewing a company's tax return and computation for any tax plan, it's the computations I want to look at. The CT600 I'm basically not the slightest bit interested in. It's just got a random collection of certain key figures that on their own are pretty, say, on their own are meaningless. Probably not to HMRC, who no doubt use them for statistical measurements, and is this too big, too small, how does it compare, etc. So maybe they're just going to have a page where you put certain R&D information to make sure you've got it right, or the amount you're spending isn't ridiculously high or low or whatever.
Yeah, perhaps an indication it's an area they're going to take a closer look at.
They don't, from what I hear, they don't seem to be taking a very close look at it. I hear stories of people who've made R&D claims without any trouble at all, really. And when others have said, well, I don't know, you don't hear many cases about it being rejected.
Yeah.
No, I did do some training with some people from the HMRC about a year or so back, and it's a lot of their inspector groups and the people who do get stuck in to the submitted returns and the financial statements, and you kind of try and gauge from that what are the hot topics. And it was still things like more transfer pricing, things like intellectual property and deductions for different types of intellectual property. So maybe they're kind of swinging around and thinking, hang on, these claims are starting to mount up, because I get asked to do quite a lot of accounting training for people who are doing R&D claims, and they come from a kind of science background, and they're thinking, well, this is qualifying R&D, but they don't have the tax background of, say, Tony and yourself, and they certainly don't have the FRS 102 background either, in terms of where do I get this information from the accounts either. So I can see there could be kind of need coming from a number of places.
I don't claim to be a great expert in R&D, although I've advised on it and made a few claims in my time, but I always find it's the scientific part that is difficult, and I usually refer back to the client and say, if you can explain to me how this is scientifically innovative, because I don't know, one algorithm for another, or if you're developing a product, are you developing something completely new, or are you just changing the color of it or covering it in a different material? Which isn't really, well, as far as the law isn't R&D at all. But also, I know the government were at one time encouraging companies to undertake R&D, and I suppose the cynic in me said, well, that's all right. If we agree lots of people claiming R&D, then we can say we've got companies spending money on R&D. I mean, you know more about disclosures, but I know a lot of R&D because it's payroll expenditure. A lot of R&D costs would be in the profit and loss account under employment costs. It wouldn't show in the accounts separately as R&D expenditure.
Yeah.
So someone reviewing a set of accounts will say this company's not incurring any R&D, but then it goes and submits a claim for a large amount because half of its employment costs are actually spent on the R&D work.
Yeah. No, that's a point.
Okay. So we've had a question come in on the panel here, which I'm going to read out. I think it's probably for both of you to input on. Have any of the panel heard whispers? Another whispers one. Lots of rumours going around at the moment. But have any of the panel heard whispers of further income tax or corporation tax payment deadline extensions or deferrals, like we saw for the July payments on account?
I've heard lots of people asking for it. I've not heard any response from HMRC or the government about it. I would say to people, only use it if you have to, because your tax liability is there. It's not going to go away, and unless you know in the following year you're going to be making a loss which you can carry back, and therefore any tax you pay is going to be refunded. There's the benefit is simply deferral. By the time suddenly HMRC are going to say, right, everybody's got to pay their tax now, and everybody will suddenly also have to pay their tax for the following year, or maybe 2 or 3 years or whatever, and so the bill is just building up. Clearly, if you haven't got the money, you haven't got the money. But equally, I've always said to clients, well, put money aside to pay your tax. It's certainly, it's got to be paid. So it's almost not your money. If you're an employee, you don't get to see your pay beyond the net pay after tax. So I think if you're a company or self-employed, as far as you possibly can, you should, if not put it to one side, build it into your cash flows.
Yeah, I've not heard anything either. And in fact, having been a beneficiary of this, having not paid my tax in July and will be waiting till the new deadline, I do see that I'm getting constant reminders that this tax bill is there, and they're actually kind of ramping up the reminders. And I did notice on the last reminder, there's the big thing from the letter. You may have seen it. That it says in big letters, interest is running on this balance, which was due in July, and then it says, in the kind of smaller print, as this has been deferred, interest isn't running yet.
Yeah,
and you can quite clearly see there is this sense of, well, if people don't spot the other letters, they might feel, I've got the money, I'll pay it. But there did seem to be more of a ramping up to start getting money back in.
HMRC did say they wanted people to pay it if they could afford to, and not to just sit on the money just for the sake of it.
And there was the other thing, the other end, isn't it, with if you are really in dire straits, people were finding that if you were keeping that money and then applying for various reliefs like universal credit, it would count in your personal savings, so you wouldn't be entitled to any credit. So you're kind of caught. I want to keep the money just in case things recover, but I can't get any other benefit. And it's not an easy time for many people, as I recognise.
Yeah, absolutely. Okay, we've got another question in, and as it begins under IFRS 16, I imagine this one's going to be for you, David.
Okay.
Do I have to include car parking spaces in my calculation of the value of the right of use asset?
I suppose the first thing on IFRS is I did cover the IFRS kind of issues in a couple of my sessions. And I also did cover the kind of UK GAAP FRS 102. And I'm presuming a few people might look at both, but I know a lot of people would be in either one or the other. And obviously, the relief is for those of you who are in the FRS 102 or any of the kind of FRS categories, FRS 105, all of this is irrelevant for the time being. IFRS 16 is only if you're using IFRS. And there was always this issue around it that you need to identify within the lease payments, what are the payments for the right to use an asset. And it's not just in buildings. I had examples with people saying, well, I've got this car. It's used in my business. It's on a 4-year lease agreement. And I've got exactly the same deal myself. I pay an extra amount per month, which covers all of the maintenance. It covers all of the maintenance costs and annual service. It covers, if I get a chipped windscreen, so I can relax. It's a kind of turn the ignition key and I don't have to worry. But that means the lease is a kind of bundle of those two elements. It is the element which is the asset, the car, and it's those services. And therefore you do need to disaggregate it and say, okay, the bit for the car is IFRS 16, and that's the bit I will need to discount to give me the net present value, which gives me the starting value in use, and the services will just be expensed as incurred. But we get the same with properties. And even with a property, you will get often the reception, which is covered by a service fee. You might get cleaning, maintenance. With the car parking spaces, it is slightly different, because under your lease, you might be allocated a number of specific spaces. So therefore you could say, well, yes, I've got the 3,000 square foot and those 6 spaces, they're mine. And therefore that is the asset I'm being allowed to use. If there is car parking in the building, but it's first come, first served, which I must confess, when I started in training way back, we had our central building in Shepherd's Bush, and the car parking was first come, first served. So we'd all get there at 8 in the morning and then go off and get our breakfast and start work an hour later. If it is that kind of arrangement, you haven't got specific use of an asset, and therefore that proportion of the rental is for the fact that the building has car parking available. And so you would just treat it like the reception, like the cleaning, like the maintenance, as another service. But if you're only being charged a single fee, £10,000 a month, you're still going to have to make that judgment. How much is for the services? How much is just for the specific bits of the building that I'm entitled to use? So as with so much with these standards, you see the standard when it's first published, you identify the first 80% of the points. And then the first year you go through, you shake all the others out of it, and you suddenly think, once the auditors have looked at it, you get these real practical points. So sadly for that one, Dean, the answer is it depends. It depends on what usage you've got of those car parking spaces.
Great. Thank you, David. We've got another question come in on the panel, and it sounds like a bit of an exam question. Maybe we've got a student on the line here, Tony, but this will test you a little bit. So I have owned a property for 10 years. It was my main residence for 3 years, and then I've rented it out for the past 7 years. Will I now not get any lettings relief, as I've never co-occupied with my tenants?
Yes, you will not now get any lettings relief. Lettings relief has gone unless you co-occupy with tenants, and the fact that you could have got lettings relief had you sold the property prior to the 6th of April this year doesn't give you any lettings relief at a future date, unfortunately. What you'll get is the ordinary private residence relief for the last 9 months of ownership, unless you occupy the property as your main residence prior to selling it, because you can then include a 3-year gap period, or maybe longer if the reason for not living there and letting it out was because you were working abroad or working away. You may have a longer period, but if you simply decided to rent it out rather than sell it when you bought your next house, then you've got to make it your main residence. If you've now got another house, that can't be your main residence. You can't just kick the tenants out and then put a camp bed in the house and go and sleep there one night a week or something and say it's your main residence. The tribunals have been quite tough on this. You've got to establish it as your main residence. It should be your registered address. Tell your bank, tell the driving license authority, etc., etc. Put curtains up at the windows. Actually live there. So it's not easy to do. I think the change in the law was very tough. I don't quite see why they did it. I'm old enough, just enough to remember when it came in, and I'm pretty sure it came in starting to go abroad to work. So they'd rent their house out while they went to live abroad, and they were provided with accommodation by their employer while abroad. When they came back, they'd made a lot of money, probably somewhere out in the Arab states, and it was tax-free. And they decided they'd keep their existing house with tenants and buy a new house for themselves. And I think it was in the beginning of the Thatcher era, they said, well, okay, we'll give them some relief for main residents without making them move back into the property. And it was capped at an amount equal to your exemption, or £40,000 if less. But £40,000 back then was a lot more than it is now. So that was the reason for it. And now they suddenly decided, oh no, it shouldn't be applied. It's maybe because the buy-to-let market has gone up and less people are working abroad. I don't know. That's quite possibly the answer. That the need for it is perceived to have changed now, but they have abolished it pretty much. Yeah,
I mean, property landlords have been hit pretty hard over the past few years with a whole range of measures to curb their tax relief. So, and this one obviously being a CGT one will probably come to fruition more a little further down the line as these properties are being sold. And I do wonder how aware lots of these landlords are about these sort of gains that are sat there upon sale that they might not realise. Okay, so we're about 30 minutes into the session now, and we've got a question on Brexit already. So prepare yourself for this one, guys. So what is going to happen to the UK when we hit Brexit? No, that's not entirely it. What is going to happen to UK accounting standards when the Brexit transition period ends on 1st of January 2021? Will anything change at all regarding either FRS or IFRS?
I mean, there's two sides to it, and I know there's been a lot of guidance given over the last probably 18 months or so in terms about what will need to be reflected in the accounts to deal with Brexit. And it's just, well, for some companies asking the question, are there real going concern issues here? If you are dependent on staff from the EU, if you're dependent on resources from the EU, I'm starting to hear about supplies for Christmas getting stuck around Felixstowe, etc. Could this, on top of everything else, be the last straw for the business? So there is the horrible kind of doom and gloom that it may have kind of be the final straw, as I mentioned. And so there is this kind of compulsion for the management to work through what the impact might be, and then for the auditors to review that. And I know I am also getting these constant reminders to get prepared for the change, although in all the guidance I see, it never seems to refer to services. There's lots about imports and exports and, getting things through the ports with custom forms. But if I go and travel and do some training in somewhere like Poland, I've still got no idea how that's going to work. So that's the one side of it, the kind of direct financial reporting. The question was the impact on accounting standards. And I think, luckily, that seems to be way down the list of priorities at the moment. So I think certainly for FRSs, we've got our own UK standards already. So we've got FRS 102, we've got FRS 105, FRS 101, although they are closely based on the international standards, that there is no reason anything should change come 1st of January. If you are following the international standards, though, it is somewhat different, because the international standards you are required to use, the international standards you are allowed to use, are the EU approved IFRS. And every IFRS which is published then goes through this approval process within the EU. There is the EU Financial Reporting Advisory Group, or EFRAG, who gives the kind of final nod, yep, we're happy with that one. So there's already two versions of IFRS. There's the full version and the EU approved, which has been the case for 15 years. So the question we had is, do we just keep with that EU approval process, or do we come up with something under our control? And obviously, given the whole nature of the project, the view has been taken that we need to take control of this. So there will be a UK endorsement process. So there will be an endorsement authority, which is just getting up and running now. We're not going to start from scratch. So they're not going to go back and think, right, IAS 1, what do we think about this one? They're going to continue with everything which has already been endorsed. But anything new which comes through will then be subject to a UK endorsement rather than EU endorsement. So there will now be 3 versions of IFRS. The full version, which they might use in some countries, the EU version, which will be used in the other 27 states, and the UK version. So we will have 3 sets of agreed international standards. Which kind of is a slow, and obviously America have gone in their own slightly different ways as well. So international standards seem to be based on local interpretation. So we're creeping back that way, it seems. Those are the most pronounced changes.
Okay. Great. And actually, on a similar vein, I remember we had the last triennial review back in 2017 that resulted in some quite significant changes from a financial reporting perspective. I'm conscious that's kind of 3 years ago. Are we expecting another triennial review? Are we going to see some similar wide sweeping changes, do you think?
Well, we are now locked into that process, and it is it's the standard IFRS approach that you put the new standards out, you let them bed in for a few years, you pick up the things to be learnt, and you make amendments, and you also deal with any new stuff which has come along. So yes, we are due another review of FRS 102, FRS 105 if you're a micro entity, and there are some really big issues out there. I mean, as we've just had in that previous question, there's Brexit, and it's whether we really want to step even further away from IFRS. But there are some major international standards which so far we have decided not to fully incorporate within FRS 102. There's very little guidance on revenue recognition. And so we're in now that position where, and this is for all companies, if you're trying to work out what revenue to report, which is obviously critical for tax calculations, you can use what is in FRS 102, but there is way more guidance in IFRS 15. And I get the attitude time and again, do I need to look at IFRS 15? Now, I would always encourage people to do so, because I know HMRC will look at it, and rather than kind of flying solo and thinking, I think this is the right thing to do, why not take support from something which is in black and white, that you can say, that's why I did it the way I did it. It's in the approved standard. So that's IFRS 15 on revenue. The bigger one, though, is, as we've had the question earlier on leasing, UK GAAP, for the time being, and the latest version of FRS 102 ignored IFRS 16 on leasing. And the question is just going to grow. Why is it that private companies can ignore that? Why is it really important for someone like Ryanair, EasyJet, to have all of these assets on the balance sheet? But if you're, Virgin Atlantic and you're a private company, you don't have to. And I think if we're looking at an environment where we've got politicians very focused on tighter regulation, tighter corporate governance, making sure things like the BHSs and the Thomas Cooks are behind us, it's going to be a very hard argument for them to say that this leasing standard, which is designed to be more transparent, we don't need to worry about it. We can just keep as we are. So there's those two specifically, and there's a few other bits and pieces. So yeah, there are some big issues which will need to be addressed, and how we go through that, I think we need to be prepared that there will be changes.
Great. Thanks, David. We've had a follow-up question for Tony on that lettings relief point. I think it's obviously one that's going to affect a lot of people. So following up on that last question, for our landlords caught out by the lettings relief withdrawal, what should we be warning them about with regard to possible changes to CGT?
Well, I mean, before we start looking at possible changes to CGT, I think the first thing you should be telling clients is about the changes that have just taken place, and using it as you said, Dean, as a way of refreshing them on the actual rules. Lettings allowance was an extension to private residence relief. It only applied if the property had been the individual's only or main residence at some time. So that's the first thing that they have to make clear, that it was actually their main residence and would meet all the tests of that. The lettings allowance was limited to the amount of the private residence relief, or £40,000. So it may, if it's only a private residence for a very short time, it may not have been much anyway. They need to be reminded that when they sell the property, they will have capital gains tax to pay. They need to be warned that when they sell the property, they only have 30 days from completion to submit their return and pay the corporation tax. Now, they'll have, presumably, hopefully they will have the money. I mean, this is individuals, of course, this isn't companies. They presumably have the money from the completion of the sale, depending on what mortgage was on the property. So there's that to consider. Keep the money aside. The accountant needs to have information to calculate the gain. Do they know exactly what the property cost and how much the expenses were on purchase? Has it been lost in the mist of time, or it's in the filing cabinet somewhere, but then so is 50 million other sheets of paper that have since gone in. So all that stuff. I wouldn't like to predict what future changes there would be. The Office of Tax Simplification are reviewing CGT. I've not seen them simplify any tax, actually. I've seen them delete some sections that no longer apply at all. Simplifying tax is not easy because, one, the government use it to influence financial behaviour, and then tax advisors, including myself, find ways of getting the best advantage out of it. Government or HMRC then consider that what we are doing was not actually what the MPs intended, although most of them, if you read the debates, weren't quite sure what was intended anyway. I'm sorry to be so cynical about this, but this is how life works. And so they make amendments, and then you have amendments to amendments and amendments to amendments to amendments, and you have some very complicated legislation. And then someone decides, well, we don't need this anymore, we'll chuck it away and start and do something different. I think, on property, I suppose the only change they're likely to do with CGT on property gains would be to change the rate of tax or include gains as income in some way. Maybe we go back to indexation and we take out inflation, the inflationary element, and we pay income tax rates on the gain. Except we haven't had a great deal of inflation in the last, however many, 10 years or so. So
sounds like you're making a budget prediction there for us, Tony.
Well, I hope not. They will always mess around with rates, but the problem they've got at the moment with rates of tax is that, one, they promised they wouldn't increase certain rates in income tax. We've had COVID, which has put somewhat strain on the Treasury, so they need more tax. because of COVID, a lot of people don't have any money to pay more tax or aren't making any profits. And so to put tax rates up would seem a bit rough on them. So quite the only way to do it, which is I think is this government's intention, is to boost profits, because if you have a low rate of tax on high profits, you can collect more money than a high rate of tax on low profits. And historically, that has been shown to be the case. So, as I say, changes to CGT, I don't know, but to look at the gains and work out your client's gains for them now. Look at the value of the property. How much would tax would you have? How much is the deferred tax on that property if it was revalued? That's probably the best way.
Yeah, I agree. CGT planning is always very difficult because, like you say, you can advise on what the situation is today, but if you're trying to give people indication of what the position is going to be in 3-5 years' time, then that's always subject to the whim of the Chancellor at the time.
Well, yeah, I mean, this Chancellor suddenly at last budget wiped £9 million of entrepreneurs relief.
Yeah. Yeah, and we just love those changes that he makes effective from budget day as well, rather than the start of the new tax year, which is always.
And he even put in anti-forestalling measures to prevent people who are in a certain situation from taking advantage of or getting over the fact that it was saved on budget day. So, they're getting much cuter than they used to be.
Yeah, yeah. So we've got another question here. It's come in a little change of topic here. We've had one about Academy's accounts direction. Is there any impact on Academy accounts as a result of COVID-19? I think that's probably one for you, David.
Yeah, I mean, it's one of those areas where obviously there's quite specific guidance issued to that particular sector because it is government supported, so they have their own reporting regime. But actually, a lot of the issues which are being identified as being specific to academies are some of the kind of wider COVID-related issues that we've all had to deal with, some of which we've mentioned already. So there might be additional grants and support available, even things like, high-profile cases like for additional meals during the holidays. For those pupils who are entitled to free school meals. So there is the kind of advice on dealing with extra grant income, how it should be reported. There might be other exceptional items, additional costs. Obviously, all schools have had to go through getting the extra social distancing, perspex screens, hand wash, and all these things where those companies have been having a boom year because all these businesses and organizations have had these additional exceptional costs getting ready for it. More classroom space might have been needed, taking out short-term leases to cover it. And also maybe various assets are out of use and are not going to be able to be brought back into use and might have become impaired. So it's a lot of the usual suspects where they're really just saying, be aware of this, have a look at it. There was some debate on reporting timetables because a lot of government gave themselves 3 months extra to report. Obviously, we've had the position taken by Companies House that for all companies for this year have 3 months extra. And I'm sure, all of the companies who leave it to the last minute will now leave it to the last minute, and they'll just be 3 months later for that last minute. But the other issue from the government reporting is they're picking up another one of the big major trends in reporting, which is being clear and concise. And all of the guidance is to try and get away from this kind of arcane language where you don't talk about government funding, you talk about supply. No one would look at that and think, well, what are they talking about? No, that's where our tax money is going. And so there is this real focus on clear, concise, transparent reporting. So if you have any exceptional costs, So there is, I think in summary on this, Dee, there's about a 20-page addendum to the normal reporting requirements, which is to pick up all of those issues specifically for academies. So yes, it's going to keep the accountants busy this year. So hopefully they'll be able to pay their tax.
Yes, I'm sure it'll keep them busy. And Academy's deadlines are always very tight, aren't they? Because they're all 31st of August year ends.
They're all exactly the same time.
31st of December filing. So, yeah, very, very tricky. I think we've got another tax question here. So a few years ago, my company issued EMI share options to key employees, and I remember being told they had to work a certain number of hours per week. Some have now been furloughed. Does this mean their options no longer qualify?
Yeah, that's a very interesting point, actually. And I must say, I'm quite impressed that the government actually, or someone at HMRC has been through all the legislation thinking about how furloughing can affect it. If you have an EMI option, you get certain tax advantages. For example, when you exercise the option, there's no income tax charge. You pay capital gains tax when you sell the shares. Otherwise, on exercising a share option, it's almost taxed as though it was paid as income tax. To qualify for EMI, you have to either work 25 hours a week, or if less, it has to be 75% of your normal working time. So if you're a part-time employee, saying doing 3 hours a day, 4 days a week, that's only 12 hours. But if you don't do any other paid work at all, then that would qualify you. If, however, that employment commitment stops, the tax benefits of EMI options disappear altogether. You've got 90 days to exercise your option, but beyond that, they've disappeared. So your share options are still valid legally, but if you exercise them, you've got adverse tax consequences. Now, of course, when people are furloughed, they're not working 25 hours a week. They're not working any hours a week. But they have introduced new regulations that say if your employment contract is such that you did qualify, you had to work the requisite number of hours, and nothing changes other than being furloughed, then that will still apply. It also applies if you're forced to take unpaid leave, or your hours are reduced. If it's a COVID-19 reason for not working the hours you would otherwise be employed to do, that will still qualify.
Great. Yeah, lots of unsurprisingly, lots of COVID-19 related questions coming in today, and I think we've probably got time for just one more question before we wrap up. So we had a question: should I credit coronavirus support grants against payroll costs in the P&L, or show it as a separate income line item?
Yeah, if I could pick this one up, there has been quite a lot of guidance which has come out on these things, and there's been guidance from the Financial Reporting Council and people like the ICAW, which did repeat the fact that if you do receive a furlough grant, you don't just net it off. It's just taking the normal principle that you show the wages and salaries as an expense, and you show the grant as income. So the first thing they're clear on is you do show the two separately. Where you show that income, it could be just down as other operating income. You could have it as a separate line item as exceptionals. If there's a quick time for a supplementary on this briefly, Dean, the other question is, if all the wages and salaries are down as cost of sales, because that's where people work, if people are furloughed, should it still go down as cost of sales? Which is almost kind of like Tony's point, they're not actually working. So how can it be a cost of sale? But then does it mean we can credit the grant to cost of sales? Now, the only guidance I've seen on this suggests that if you want to take to strip things out as exceptional and say, oh, this was COVID related. So if you were saying we want to take all of those wages and salaries and now treat them as exceptional because they're due to COVID, that should only be used for incremental additional costs. So it's almost at the same point. These are employees who normally work on the production line or, are direct costs, so they should carry on being classified. And therefore, it would seem to make perfect sense to have the COVID, the furlough grant receipts relating to them as an exceptional line item, as kind of exceptional cost of sales income, which would seem to be a kind of fair presentation. But it's really being driven by what you think is clear, transparent, and a true and fair view. But don't net them off, definitely.
Okay, that message is loud and clear. Thank you, David. I think we're about at time. So thank you very much to our expert speakers today, David Potts and Tony Austin.
Thank you.
Don't forget to join Professional Accountancy online community on LinkedIn to continue the debate after the live session and to be included in exclusive offers for future events. A recording of today's live Q&A will be sent out by email within the next couple of days. There's still time to watch that pre-recorded content that David and Tony produced. Your expiry date will be displayed next to the webinar, so I would encourage you all to go back and watch or re-watch those. There's some great content in there. Feedback forms for the event will be sent out when the event closes. By completing this, you will receive your all-important CPD certificate. And don't forget to visit the online exhibition, profaccountancy.com. By visiting the exhibition, you can access a free 1-hour CPD webinar from the 2020 Distance Learning Catalogue worth £35 plus VAT. So thank you once again. Thanks for joining us today. Thanks to the panel and have a great day.